Welcome to the worst housing affordability since 1989, everybody. The affordability of housing in the United States continues to get worse and worse. It's placing it now out of reach for more and more Americans. It was more expensive to buy a house in the US in June than it has been for more than 3 decades now. And this was because of all-time high prices of homes, then clashing with the run-up in mortgage rates. The National Association of Realtors Home Affordability Index, which factors in household income, mortgage rates, and the sales prices of existing single-family homes, fell to 98.5 in June, which marks its lowest reading since June of 1989, when the index was at 98.3. Home sales numbers reflect this unfortunate tragedy, as existing home sales have now declined for 5 months in a row. During this time, interest rates have soared, housing prices continue to climb steadily, and it's led now to the steepest erosion in affordability in years in the U.S. housing market, driving even more buyers from the marketplace. And even with the smaller transactions, prices continue to climb compared with the year before, as inventory of homes for sale across the U.S. remains below historic levels. The decline in affordability makes it particularly difficult for first-time homebuyers to get into the market and take advantage of what has really been the longest traditional pathway to building wealth here within the U.S. middle class. First-time buyers generally have to save up for that down payment, and as housing affordability worsens, the time required to save up for the down payment, it balloons, and then it leaves potential buyers with the prospects of renting for much longer years, and in some cases even decades might be the case. Now, fortunately, it's not all bad news in the housing market, as conditions have loosened a bit over the past few weeks. Mortgage rates have reached their highest point in 13 years in June, but they've been trending down ever since. Some slam dunk buyers have been hitting the market again in July and in August, according to Realtors. NAR's chief economist, Lawrence Young, had this to say about the market conditions. Thankfully, the worst in affordability could already be over for this cycle. Mortgage rates have calmed down in recent weeks, and the consistent wage growth is narrowing the gap with home price growth. According to NAR, existing home prices have jumped 46% nationwide over the last 3 years alone, everybody, and that's driven much of the period by buyers seeking more space amid the pandemic. I mean, myself included, went out and bought 5 acres just wanting a little bit more breathing room. But still, buyers buying a home right now, it remained relatively affordable through 2020 and 2021. Mortgage rates fell to historic lows. It offset most of the increase in prices for buyers. But all that was undone when rates began rising earlier this year. And rates this week are up to 5.22%, which is an increase of 3.1% since 2021, according to Freddie Mac. The higher borrowing costs are really due in part to aggressive efforts by the Federal Reserve to curb inflation by rising interest rates, which is something that we've talked in length about here on the channel. I'm going to throw links to those videos in the description for you below, so you can easily check them out. Housing economists are predicting price drops in some of the markets that showed the strongest price gains during that period of time. Places like Boise, Idaho, Austin, Texas, Phoenix, Arizona, they're already beginning to show signs of significant slowdown. Nationwide, economists expect house prices to slow substantially through 2023, with some projecting smaller price decreases from one year to the next. However, years of sluggish new home construction after the Great Recession really left the housing market short on supply, and that's likely led to the prices staying higher than they would have been had that supply been there. Nicole Bashad, who's an economist with Zillow Group, believes that prices won't actually fall by much at all. We're going to do another Real Estate is Doomed video, so be on the lookout for that. We'll talk more about this. But she was quoted saying that we're not going to go back to the 2019 prices, and that even if prices start to fall a little bit, it's not going to be in any meaningful way that impacts affordability. If there's a silver lining to our current market outlook, it's that mortgage interest rates are actually lower today, while housing prices and incomes are higher than they were the last time affordability was so low. According to NAR, the average existing single-family sales price was $423,300 in June, and the median mortgage interest rate was 5.6%, with a median household income of $91,952. In June of 1989, the median existing single-family sales price was $94,800. The mortgage interest rates were 10.6%, and median household income was $34,128, which means that the current average existing single-family sales price is 4.6 times the current median household income, while it was 2.8 times the median household income in 1989. So it seems like we're far worse off today, but remember that the mortgage rate back in 1989 was 10.6%, while it was just sitting at 5.6% in June of this year. So if we compare the two side by side, we actually find that back in 1989, the average home cost approximately 30.7% of the median household income, while in June of this year, it cost only 31.7%, showing that that difference is really made up by the 5% in interest rate differences. So that interest rate really does make quite a difference. And we've seen that difference in recent rise in rates. According to NAR, the typical monthly mortgage payment rose in June to $1,944, which is up from $1,297 in January and $1,265 in June of 2021, assuming a 30-year fixed rate, 20% down, etc. So this massive increase not only is wreaking havoc on buyers and sellers, but new home builders also. Major home builders like D.R. Horton, Pulte Group, these guys reported in July that they saw a higher rate of home cancellations for last quarter than they did the same time last year. So how has consumer sentiment fared with our recent lack of affordability? As you would expect it, everybody. The percentage of consumers polled in July by Fannie Mae saying that now is a good time to buy a house fell to 17% in July, which is down from 28% the previous year. And the percentage saying that now is a good time to sell a house fell to 67%, which is down from 75% a year ago. So I'm curious to know, how are you feeling about the current market? I'd obviously be interested to hear your thoughts. Make sure you leave a comment below. Don't forget to share this video and drop a like for us if you found it helpful. Looking forward to sharing more information with you soon. Until then, make it a great day and keep on cash flowing. See you soon.